Anurag Singh. He's managing partner at Ansid Capital, joins us right now on the show with his thoughts. Anurag, good having you. Thanks so much for joining in. Good morning from us here to you. This concerted buying in markets across the world yesterday, particularly India, but the rest of the world too, was left us thinking about what the possible reasons could be, because after a long time we also saw foreign flows coming into India in a big way. Was it this talk about China looking to cut mortgage rates, or is the market preempting a rate easing cycle from global central banks?
Yeah, Neeraj, good morning. I think we are talking for the first time on the channel, so good having, thanks for having me here.
Pleasure is ours.
Neeraj, look, I think it's, the runway is pretty clear, right? And, we all, the rates peaked out pretty much last June sometime, right? And after that, the conjecture has been how many rate cuts we'll get in 2024. Eventually, I think we'll get probably 3, so 25 basis point in every meeting. And that's a good enough start. I mean, just look at it in this context, that ultimately when they were raising from 0 to 5.5, then we needed a 50 basis point and a 75 basis point. But now, once they are kind of going back to something like a 3.5 by 2026, all we have is like 8 rate cuts. So my sense is there is no 50. I don't know why the market plugs in 50 sometimes. There's no crisis on that front. But I think that's a good start. And if the rates eventually 10-year yield is already indicating 3.6, 3.7, and market really has eased out a bit in that sense. So I think, yeah, there is no, the economy is doing solid. The proverbial soft landing has been achieved, and Fed has pretty much done the impossible, right? So in that sense, I think US markets look very solid and very robust, at least for the next 2-3 years. There is no risk to the economy as such. So I think the estimates vary, but you take an estimate of about $250, $240 for S&P this year, and then S&P is a fairly valued number at 5,600. Next year estimates are 6,000 to 65,000, right? So sorry, 6,500. So that's where we are, right? I think so. There's no kinds of concern from the US economy perspective. Let me just quickly touch upon the FI number, Neeraj. There's a bit of an opaqueness around who actually buys this. But my sense is, that the funds like BlackRock, for example, they saw outflow of about 1.5 billion again in August, right? Because of which, if the ETF see an outflow, then eventually every emerging market sells. So there is a bit of a, concern still, despite Indian valuations. If the ETFs continue to see outflow, then I think emerging markets will continue to see outflow, regardless of how the Indian market is doing. Neeraj.
Anurag, hi. It's also Samina joining in. It's rather interesting how swiftly we go from concerns of a hard landing, worries about a recession, to a healthy economy. I mean, it literally takes 24 to 48 hours for the street to change its mind. We all do agree that equity markets preempt what the economy is going to do. And I think there's no fair way of saying whether the economy in the US is healthy just yet. But what we do know is that if a rate cut does come in, emerging markets become a preferred bet. And we've also seen historically the RBI follows on with the rate cut after the Fed to keep the rate differential in place. In that case, do you prefer equities or debt in India?
So, Samina, I would take equities any day in a falling rate environment. Now, I understand usually we recommend a 70-30, 30 being a debt, and 70 being equity. Equities benefit with a rate cut, and bonds, of course. I mean, look at if the rates in US, even in India, for example, if the 10-year yield kind of eventually drops to 6%, there is a good return to be had in bonds for the next couple of years, right? US, there is a bit more return to be had because the cut is relatively going to be higher from 5.5 to 3.5. So that's good, but it depends on your style. Ultimately, I don't think in India, no matter how much we talk about it, anybody is going to listen to us if we tell or recommend invest in bonds, because that's not the environment right now in India. In US, 70-30 works pretty fine. If not 60-40, 70-30 works very well. my style personally, and a lot of people, we love it when the rate cut happens. US markets, I think we must, I mean, you would know this as well. It's very highly skewed, right? So about 35% of the market cap contributed by 6, 7 stocks. I think the rest of the market is really at a very mouth-watering valuation. So look at Russell, look at S&P 600. So I mean, look at financials, healthcare. These are the sectors that do well when the rate cut happens, right? So I think that's a very good position to be in. There's a bit of a broadening of the market that's happening out here in US. India is a very different story. So, that'll have to be seen very differently. Quick comment on the RBI piece, Samina. I think, look, so one is this, the CPI in India, the index, I think just a quick thought, and I'm sure the wise people know this better. The CPI needs a bit of a reject. I think the 50% of CPI is food inflation in India. So I don't know whether RBI rate cuts impact or doesn't impact the inflation number as such. So that's a bit of a long-term project that India has on its hands. Other than that, I think, yeah, I mean, RBI can cut. I think across the world, rate cuts are happening. So RBI has got a green signal even from European Central Bank or federal. I mean, they don't need an official green signal, but they were trying not to preempt or, prejudge Federal Reserve. So at least in that sense, I think next week we'll also have that signal. So yeah, all looks good, except that the two markets are very different. India is on a very different trajectory, and US is on a very different path altogether. Samina.
Thank you, Anurag. You have a great Friday ahead and a good weekend too. We'll catch you soon.